Hello everyone, my name is Emma Reese. I work at the Better Policy Project, a project designed to improve economic and financial literacy. You can find more information about the project here on our YouTube channel or on the Better Policy Project website at www.thebetterpolicyproject.org. Today, I'm presenting Douglas Laxton, the director of our amazing project. He has a wealth of experience working with various central banks, creating and developing their frameworks. He has worked with the Central Bank of Canada for 13 years. He was the creator of the very first quarterly projection model. He was the head of the Economic Modeling Research Division at the IMF, working under Olivier Bouchard, as well as other distinguished IMF economists. He has an extensive portfolio of research and multi-layered surveillance. He's worked with multiple central banks, for example, the Central Bank of New Zealand, Armenia, the Czech, just to name a few. He will be sharing his expertise and knowledge in this short lecture and the upcoming ones. We also have a summer bootcamp coming up. It is going to be physically based in Portugal, but you can also participate on it online. It sets the beginning of the Global Forecasting School. And you may ask yourself, what is the goal here? The main goal is to have the best of the best standards in macroeconomic analysis, policy analysis, surveillance, as well as analytical work modeling. This week, we're going to be focusing on the surveillance part, where the students are going to be learning how to follow the US data, as well as to apply the analytical framework that we use in Advanced Macro Policy Modeling 1 and 2. These are two courses that all the students will need to understand and be able to apply to real-world situations to achieve level 1 in the Global Forecasting School. So feel free to hit the subscribe button if you are interested in learning more about this, and you are more than welcome to follow along. The plan is to release five abbreviated videos this week, and by the end of the week, you will have a deeper understanding and be able to assess for yourself what is the probability of a fiscal crisis and global financial crisis in a year or in 5 years, and form your own opinion and analysis on the current state of the economy. Thank you for joining us today. Let's get started.
And I'm director of the Better Policy Project and the Global Forecasting School. I have some students coming into my boot camp, and we're going to be training them to be the best of the best economists. And one aspect of that training, it's called Advanced Macro Policy Modeling, is following the U.S. economy and understanding all the key relevant data. What's different about the Global Forecasting School is we take a perspective about asset values and so on, and we factor that into the risks of potential scenarios that we could get. And so the question I want to ask is, by the end of this week, I'm going to make 5 short videos for my students. But if you're interested, you can follow along. You'll get the abbreviated version. Okay, so the very first thing that I want to draw attention to is the Federal Reserve Board's estimates of the household balance sheet. Okay, so this is looking at total assets and liabilities of the household sector, and it is staggering how much equity prices and property prices, plus some financial saving that took place during COVID, because there was an increase in precautionary saving because people were unemployed and faced the prospect of unemployment. But in addition to that, people just couldn't buy all the types of things that they wanted to buy during lockdowns. We couldn't go to restaurants, and we couldn't take our international vacations and so on. And so as a result of that, there was a financial saving that accumulated into financial savings. But in addition, there was a whopping doubling in equity prices. So the S&P from the end of the first quarter in 2020, which was about 2,500, surpassed 5,000 by the end of 2023, the end of last year. And it's continued to increase since then. We'll get an update of the U.S. household balance sheet in about a month, but these numbers that we're looking at go up until the end of 2023. Now, these are one things that I want you to focus on. The question that we're going to ask by the end of the week is, could we have another global financial crisis? So what's the probability of another global financial crisis? And for that question to make sense, we have to talk about over what horizon. So could we have a global financial crisis over the next year? Or maybe could we have another global financial crisis over the next 5 years? So I'm not going to tell you what my answer is to those questions. I'm going to show you how to think about this. And I think once you do that, you might be as worried as I am, maybe even more worried, or maybe less worried. It depends on how you think about the problem. So first of all, let's look at the numbers. So we're going to be focusing today just on the asset side of the U.S. household balance sheet. So the very first thing is how big is it? So we're going to look at the change since the end of the first quarter in 2020. So when COVID hit in February, we had a collapse in global equity prices of 35%. That sort of made sense in the sense that it was a period of high uncertainty. Plus, there was lockdown. So when you produce less output, equity prices, which should be the discounted expected value of output now and in the future, that should have gone down, and it did. But with the highly stimulatory macro policies, in other words, the combination of the a big fiscal stimulus in the US and other countries as well, but particularly in the US, combined with very accommodative and stimulatory monetary policy that drove real interest rates down. And so that we're going to argue could have contributed to a massive bubble. We're going to be focused on the US household balance sheet. If you're worried about the US household balance sheet, you should be worried about virtually every market in the world. But let's show you how big the numbers are. So we're going to be looking at the assets. So that's, you can see in the first column, they're measured in billions. I don't know why. I would prefer to measure them in trillions because we don't need that many digits to understand what's going on here. So maybe that's what the problem is, that they have too many digits to understand what's going on. So we're going to look at 23 Q4, and we're going to be looking at assets. Okay, and what is it? Well, you can see it's $177 trillion. It seems like a big number because it is. And we're going to look at the change in that from the end of the first quarter, okay, in 2020. And that's all the way down here. You see that was $127 trillion. Well, you know, that's a humongous number. Okay, so that's $50 trillion. Like it's mind-blowing. That's how big it is. No, $50 trillion, and the entire value of goods and services of the US economy in 2019 was $21 trillion. So the increase in household assets, because of a doubling in equity prices and because property prices have gone up by 50%, and again, plus some financial saving, has resulted in a $50 trillion increase in assets. Well, the household balance sheet, you can also split it, those assets, into non-financial assets, which are basically housing. So I'll just say housing here, okay? So that's the value of all the houses in the US, plus what we call financial assets, okay? So those are, you can think of that as being a combination of equities, Okay, so if you think of a person's portfolio, they would have so much in stocks. They would have so much in what we call fixed income securities, or you can think of that as saving deposits or government bonds and so on. And so much in liquid assets, that would be like cash. So what was non-financial assets? So you can see now non-financial assets are $58 trillion. Well, in the first quarter of 2020, they were $41 trillion. And so you can see we've had a plus $17 trillion increase in the value of houses. Okay, so of the 50 trillion, okay, 17 trillion was a result of an increase in property prices, or there might have been some new houses that were built as well, but it would be mainly an increase in the value of properties. And again, financial assets. So you can see it's 119 trillion now, and back back in the first quarter of 2020, it was 87 trillion. Okay, so that is 32 trillion dollars. Okay, you see, almost adds up to 49 trillion. That's just rounding error and stuff. So what happened? Low real interest rates, partly because of inflation. With interest rates low and inflation higher, real interest rates are interest rates minus inflation. So those real interest rates went way down. And in addition to that, there was a massive fiscal expansion. And that, at the end of the day, has resulted in a $50 trillion increase in the household balance sheet. We have some empirical evidence that we're going to be presenting by one of my students, Miriam, that shows that our classical consumption functions that feature real disposable income and a measure of household wealth fits the data, again, just as well as it fit the data before COVID. And that's why consumption has been so strong. And that's why we probably are going to need higher interest rates than what's priced in financial markets. And you'll find out this week that higher interest rates could be very dangerous for debt dynamics, because with government debt around 100% of GDP, and with a big primary deficit, in other words, government expenditures being higher than taxes, higher interest rates mean higher interest payments. And it's going to mean either a lot of fiscal tightening in the future is going to be required, or if the market perceives that the political institutions in the US are incapable of eliminating that deficit, it could result in a crisis in confidence. If there was a crisis in confidence, interest rates would rise even more, and we would end up in a situation much like the European debt crisis that we experienced after the GFC. Well, bottom line is that if there was a perception of a fiscal crisis in the US or other countries because of higher interest rates, there would almost certainly be a global financial crisis. So now, again, that is only one scenario, but it's a scenario that I think we should be worried about, both as policymakers and as individuals that are looking to be prudent in terms of the way that we invest and manage our assets. So that's Doug Laxton at the Better Policy Project and the Global Forecasting School. If you like this analysis today, stay tuned, subscribe, and you'll learn about the other videos that I'm planning to make for the students this week.
Thank you for watching our video. For more information on the bootcamp, you can go on the Better Policy Project website and scroll down. you have the option download brochure, and there you will have all the significant dates, the designated speakers that are going to be giving the classes, and also how, like, a small introduction to how the bootcamp is going to work. Then we can also take a look at the courses that we have available. These are courses that help any economist or beginning economist to learn how to use these programs, such as Python and Diner Julia, MATLAB, all these important programs. Thank you so much, and hope to see you in the next video.